In a sense, I was already doing syndications in a sense, without even really knowing what that model really was, without even really knowing how it worked. But the benefit to me was I amassed a portfolio of dozens of units to the tune of a little more than 100 units that I also self-managed. Gave me great real estate experience, great management experience. I learned where all the landmines are, right? All the hardships, anything a landlord can go through, I went through, which positioned me really well eventually when I realized there's so much demand for this service in the market, which ultimately pushed me to become a syndication operator.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Kris Morin. Kris is the co-founder and head of investor relations at Three Peaks Capital, where he helps professionals nationwide diversify their portfolios and secure robust financial futures. Kris, welcome to the show.
Tim, thanks for having me. Excited to be here.
And it is great to have you. So we're going to get into all the work that you're doing at Three Peaks Capital. But before we go there, Kris, please tell us more about your background and how you got started on your real estate journey.
Yeah, sure. My real estate journey for me really began around the Great Recession, or at least leading up to that, around 2008, 2009. Rewind a little bit. I'm a young consultant at a firm called Accenture. Some of the listeners may be familiar. I was a management consultant traveling the country, working with some of the biggest companies in the world, solving some of the most forward-thinking problems at the time. So by all means, as a young 20-something, I had it made. And the benefit for me was I was making a lot, I was traveling, and I was doing quite well. I was moving through the ranks quickly. And I had a realization very early on that I think folks tend to get to maybe later on, and that was all that achievement was coming with a great deal of sacrifice. I wasn't leaving time for myself, my health, my sanity, right? I was working long, long hours, early mornings into the late evenings. I was on a plane every single week. I'd leave on Monday morning, go to some other part of the country, come home on Friday, and I'd blink my eyes and I'd be gone again. It came with a lot of sacrifice. And I was burning out. I was having this revelation that, is this what it really takes to ultimately become successful, continue to earn more and earn title and money? And I started to question whether or not that was truly something that I did want, or whether that was sustainable. I was 27-ish at the time, 26. And to think that I could do that for 30 more years, just, it wasn't feasible, right? And already I was getting discouraged. I knew I couldn't save my way into retirement, and I certainly didn't want to continue to sacrifice for that long. Now put that thought aside for a second, because now here comes the Great Recession. Then I watched a great deal of the American population, particularly the boomers and others at the time, have half of their net worth ripped out from underneath them at really a moment's notice. And right at this time, I'm having this revelation and this thought that, man, I can't bear the thought of doing this for another 30 years. And then imagining that if I did, there could be this event that could tear half of it away from me, or worse or more. I knew there had to be a better way. I just couldn't accept that I would knowingly accept that level of risk and put myself in that situation. I knew that there had to be something that could be done now, and I'd be doing myself a disservice if I didn't. I started to research, what do the wealthy do? They have a heck of a lot more wealth than me to preserve. Ray Dalio is famous for saying, Ray Dalio, founder of one of the largest hedge funds in the world, said, preserving wealth is harder than making it. And these guys, like I said, have a lot of wealth to preserve, a lot of wealth to be gained. What are they doing? And so you start doing some research, and there's a lot of public data out there. And of course, real estate continues to be a theme that rises to the top again and again, acquiring different types of assets that produce income, traditional private equity, real estate private equity, this whole world of alternative assets. Real estate, I just knew it was something I had to figure out. I didn't even know if I would like it, but I knew it was something I had to figure out to add additional income streams, build that layer in that kind of protection that would shield me from those types of economic losses. Because again, I didn't want to be a victim of another Great Recession. So that was really the genesis of a real estate journey for me. I continued to work, obviously, continued to do really well over the next decade. And as far from a real estate perspective, I followed the blueprint I think a lot of people are fed. And that is, hey, you got to go flip houses, you got to make these sums of money, and then you can turn around and buy multifamily. The benefit for me, I was just extremely driven. I was pretty savvy. So I figured out how to leverage local universities to feed me college interns who could take phone calls from my marketing while I was some other part of the country doing work. And then I created specific incentive contracts with contractors and realtors who could visit properties and do scopes of work for me. Basically everything I needed to do to establish a flipping operation. And so I started flipping houses. It was going pretty well. Fast forward 2015-ish, we're well past the recession. and I'm doing quite well in my career at this point. My business is firing on all cylinders, but I am burning out even worse than before because anybody who's flipped houses knows it can be great money, but there's a lot of risk involved. You can lose money too, and not every deal is going to go perfectly. And it's a very active role. You're a marketing expert, you're a salesperson, you're a giant babysitter of contractors, and there's a lot that can go wrong, right? Again, it's an active role, and I think that's the one thing I really want to emphasize. And I remember hanging up the phone. I was in Richmond, Virginia, in a hotel room, and I live in Connecticut. Most of the deals I was doing it were in Connecticut, and I remember thinking, man, this isn't passive income. This isn't why I got into real estate. I don't even want to do this anymore. And so I let the business run itself out, and all the projects that were going, I let them run themselves out. And I took about a year off. I just focused on my career. That didn't last long. I got the itch again, and I came back and started buying multifamily. And I'll tell you, so really from 2016 until current date, I started buying multifamily, and of course, I started small. I was buying 3 units, 4 units. I had a rule. I didn't want to go less than four if I could. Just more units is better. You have a couple of vacant units, you're still profitable. And that eventually morphed into this real estate private equity, which is more focused on middle market, small commercial today. But I think for me, the light bulb, I'm glad the light bulb went off that multifamily real estate is truly the path to wealth. But I regret not doing it sooner. So anybody out there who's thinking, oh, I got to flip houses and buy multifamily, if that resonates with you, I would say you don't necessarily have to do that. If I could do it all over again, I would jump into multifamily. There's lots of ways that you can hack your way into a deal. If you don't have the income, you can raise it, you can borrow it, you can partner. Lots of ways to do it. I wouldn't focus on capital as being the limiting factor. So I would urge people to get into multifamily. If anything, do that first. Build up your cash reserves, build up your equity, because flipping is really a very risky game. You could do that later. That's something you can absolutely do later. So I probably would do it in reverse order. But that's really the short version of the story for me. But when I got into multifamily, it was I didn't use my own money. Sure, I had my money, but I always like to keep capital on hand, reserves for emergencies. And I figured out early on when I was flipping houses, because what I really didn't tell you was going all the way back to my roots. I was actually a high school science teacher at one point in time. Point being, I didn't come from money. I didn't make a ton of money then. I didn't come from an entrepreneurial family. I grew up in a small farm town. Like, I just want to paint the picture. I had no advantages here, right? Not an entrepreneurial bone in my body from a family's perspective. But I figured out how to raise money. It's easier than listeners might think. And I basically, the same way I would for a multifamily syndication, I was raising capital from other people, creating personal agreements with them where I would provide them a specific amount of interest or return on their money. I'd go buy the properties, manage them, improve them, and eventually sell or refinance them and return all of that capital to investors. And in a sense, I was already doing syndications in a sense without even really knowing what that model really was, without even really knowing how it worked. But the benefit to me was I amassed a portfolio of dozens of units to the tune of a little more than 100 units that I also self-managed. Gave me great real estate experience, great management experience. I learned where all the landmines are, right? All the hardships, anything a landlord can go through, I went through, which positioned me really well eventually when I realized there's so much demand for this service in the market, which ultimately pushed me to become a syndication operator. Having the business acumen that I had built over the years, at that point in time, I was acting executive director for a $4 billion company in Connecticut, combining all the operations and business and economics experience that I had with the real estate acumen that I had. I knew I was ready then to really start borrowing money at scale and lead a company that could buy and acquire and manage real estate profitably. So that's Three Peaks today, now focused on acquiring. We're boutique in the sense that we don't have 2,000 units like some of the guys out there. We buy slow and buy right, like I say. We're also boutique in the sense that we don't attack 200, 300 unit properties at a time. It's institutional territory. We're much more competitive and effective in the 30, 50, 70 unit range. That's historically been our benchmark. And we're able to acquire these properties in key markets across the US, underpinned with good market fundamentals. I'm happy to talk about what I think that means. And we reposition them. And we've done a really good and effective job at strengthening these assets and returning that capital back to our investors. So that's really, I was going to say a short version of my story, but that also feels like a long version of my story. But that's about all of it in a nutshell.
That's awesome. And there's so many valuable lessons to pull out of that, right? Just straight from the beginning, you talked about 2008, seeing 2009, seeing all these people lose half their money. And I was in an interesting position myself in that time because I was in the military and I was just getting ready to get out of the military in 2008 and go into grad school, which I don't know, I guess you could call that a positive because I was in business school and I was seeing all of this stuff like happen in real time. The unfortunate part is even the professors had no idea what to think because it was so unprecedented at the time. It was truly one of those like black swan type events that there wasn't a whole lot of historical context for. So it was certainly interesting from that perspective. But even I got hit because I had a retirement account in the military, and even that had lost half its value. Luckily, it was early enough on. I think I had 40,000 in there, which was a lot for me at the time, but it had gone down to 20. And I was like, oh man, that really hurt. But it was just one of those things where you just move on. And you're like, all right, let's go on to the next thing. And then you talked about your time in management consulting, which is something I looked at too, coming out of grad school with my MBA and everything. I was like, okay, I'm looking at the three-letter agencies, the BCGs and everything. And I was like, I'm going to solve problems, because that's what it essentially comes down to is for management consultants is you're paid to solve problems. And I felt like that lent really good with my background as a military officer because it was very similar in that regard. So I was doing all the case studies and everything. I'm glad in retrospect that I didn't wind up going down that road because of the burnout aspect that you talked about. I think that is a young man's game because they know they can just drive you into the ground. And when you're in your 20s, there's a high threshold there, right? At that point, I was in my 30s by the time I graduated grad school. So I don't know how long I would have been able to grind it out, but it was interesting to hear you talk about that. And then the other part, which I want to key in on because of the flipping, right? We hear a lot of people talk about getting their start in flipping because it's real estate, right? And it's one of the things we see the most. It's like the flashiest, HGTV and all of that stuff. But I think unless they start doing it, they don't realize how active it is, which is, I think, the point that you were hitting on. It is not passive in any way, shape, or form, which makes it, I would argue, very difficult to do with a full-time job. It sounds like you were able to do that, but I have to imagine, like you were alluding to, that the time alone trying to deal with all those things from contractors to loans to everything else outside of work hours was really weighing down on you at some point. Is that the case?
It was, but I was good about removing myself from that process as much as I could and making sure that any time spent was on the more critical items, looking at projects where we might be on or potentially running over budget and inserting myself and having conversations to make sure that the train stays on the rails. What I really did was I mentioned forming relationships with universities to feed me interns to do some of the basic tasks that they could do. I had a realtor who also had some flipping experience who I created an arrangement with him where I basically said, hey, you're going to be my guy. You're going to check on these properties at this frequency. And ultimately, you're going to be compensated based on performance. And it was a sliding scale. And if we ran over budget, like this guy wasn't getting paid. So he had real incentive to make sure it worked. And I found creative ways to remove myself without being reckless and removing the controls necessarily. And so I can watch it from a distance and stay over the top. And I even had given somebody a power of attorney to sign and close deals for me while I was away. Sometimes deals closed while I was away. I was really good about establishing sort of a streamlined operation. And at the time, different types of workflow systems really, I would say, only emerged in the last 10 years. They didn't really have anything back then that would have been super useful. Like I just even think of something like a Monday.com where you can track all the tasks and, like I said, assign things to people and see where they're at. I literally ran all of this off of Google spreadsheets and Google Docs on the cloud. So it was very archaic in that sense, but I used the tools that I had at the time. But I think it's one of those instances where if you just think about what do you have at your disposal, what's important for you to pay attention to, what aligns to your skills and interests, and how can you quickly find somebody else to take the things that don't align. I'm thinking right away of a book, Who Not How, and it's right behind your head. The whole premise of the book, right? There are people out there who can do those things. And so I just wanted to steal a moment to call that out because that's a little bit of what I'm alluding to here. And that was critical to my success early.
Yeah, and that makes a lot of sense. And don't get me wrong, like you certainly can make money in the flipping game. And I've known a few people who have been very successful at it. But the things that I've noticed that made them very successful were teams and systems. Because they had those teams and those systems in place and they were very good at both building them and running them, they were able to reach the scale that offset some of the risk that you talked about with not every deal working out. and just the time required to commit to it. I'm biased to multifamily and would would still argue that other forms of investing within real estate like multifamily, syndications, etc., are more tax advantaged. But again, these are all like taxable events, so there's ways that you can find to offset those impacts. So I won't get into the weeds on that stuff, but let's talk a little bit about your company. And I thought it was interesting. So many folks are like 100 unit plus, like we don't even look at it if it's less than 100 units. And you specifically called out that you guys are in that range right before that. You said 30, 50, 70 range. And I guess the problem with unit count is it's relevant in some ways, but not necessarily in others. And what I'm thinking here is price, right? So like a 70 unit in Connecticut may be a lot more expensive than a 150 unit in Arkansas. So what is the correlation there? And is for you guys, for your buy box, for lack of a better word, is it based more on that unit count, or are you looking more at the price based on what you think you can raise from investors, etc.?
It's a little bit of both. It really is a little bit of
Okay.
both. Like you said, there's definitely a huge discrepancy on market type, and I think you chose a really good example. 70 units in Connecticut probably does equate to 150 units in some of those markets. It was a combination of unit count from a unit count perspective, because the deal just naturally the pricing is higher, but it's too big for the small landlords. And it's small enough where the really big guys, they're not paying any attention to it. So it allows us to be more competitive. It's also a more challenging space, not only not to compete, but to manage. So for
Mhm.
those folks who aren't aware, one of the reasons why operators will draw the line and say 80 or 100 units is because now the property generates enough profits where it can sustain itself. It can afford a full-time leasing manager on site, full-time maintenance manager. That's all these people do. They wake up on Monday morning, they report to your property only. You got 50 or 70 units, you're underneath that threshold. You've got a partially allocated leasing manager from a property management company. That person is spread across multiple properties, probably within the area, so it's not unreasonable.
Sure.
But that's the same for the maintenance person. And a lot of times you're outsourcing additional work when you're doing unit turns. And so you don't have somebody who's available at your beck and call to go turn the units vacant. Hey, can you come and can update it? We have to get heads in beds right away. You're really succumbing to this particular market. And we felt that say, hey, we can't get there for at least 2 weeks, but then we'll turn the unit, right? There are those types of pressures that you face. So there are unique challenges to managing smaller properties. But aside from that, and we have the networks, we have a lot of the expertise and experience in this space. So we do particularly well there. So that's why we target it. But getting back to your question, our buy box is typically going to fall in the Indiana space. You're looking at anywhere from 3 to 5 million. If we're buying, and you're talking 50, 60, 70K a door, if we were buying 20 units in Seattle at 200 plus K a door, it's $5 million just for 20 units. That does change a little bit. And we like that space because the equity that you're raising at any given time is 1.5 million to 2.5 million. I wouldn't say it's easy, but it's a lot easier than raising 25 million, right? To get more deals done. It's just a different business model. And like I said, we do really well there. And a lot of what we found, a lot of retail investors out there, LPs who invest, they also have an appreciation that with scale, there are benefits. There's lower risk, because I always say if you buy a 10 unit apartment building versus a duplex, you're taking on, some people say to me, oh, Kris, I'm going to start small and safe. I'm going to do a duplex. I'm like, well, you're really taking on a lot more risk. You have one vacancy, you're potentially in the red, right? You're dipping in your own personal paycheck to float the expenses and pay back your investors. That's not the case. So the larger you get, that expense decreases. But then it gets to a point where if you're not really good with your management, you're not really good at managing property managers, any small deviation in your business plan, the bigger that property gets, the bigger that deviation gets. So it's an inflection point where that risk compounds again, right? So there's a sweet
Mhm.
spot. And I believe it's in the 30, 50, 60 unit range where if you manage it, you can really control the risk a whole lot more effectively than you can on 150 units. So I went on a little bit of a tangent there. It's a little bit of philosophy, but I think based on experience too, there's really a number of reasons why we target that space. And price is a part of it, but it's not the whole.
Yeah, and
Hopefully that
I
makes
think that,
sense.
yeah, no, absolutely. And like you said, there's nuance there, right? It's multiple reasons. Yeah, I did want to hit on, we've talked a little bit about raising capital. And when you were giving your background, You talked about it being, relatively easy for you to raise money from other people. And I'm assuming you're talking about, when you were getting started mostly for those flippings, but obviously you're doing a lot of raising money now for these larger syndication deals. Talk to me about, because I think a lot of people are listening or, hey, I don't know anyone who has money. Like, that's the first thing that comes to mind, whether it was me when I was looking at a duplex and didn't have anyone to partner with, or anyone I knew who had money who would trust me to do the deal, take care of it, and kick them off profits, or people who are just getting started doing the syndication side of things. They're like, hey, that'd be great, but I don't know a lot of rich people. How did that start out for you, both at that low level, and then how did that kind of, I guess, evolve once you got to the syndication side of things?
Yeah, that's a great question. I think we all have the same reaction. I was there too. I don't know anybody with money, but that's just not true. And anybody who's been through the process will tell you that. And if that's really true, you don't know who your friends and family know. I always say we all know somebody and be like, I'm making this up. Dan knows everybody and everybody seems to know Dan and everybody loves Dan. He's the most connected guy in the world. Dan might not have money. In your head, Dan's the most connected guy in the world and everybody responds positively to him. Be great to get on the phone with Dan and say, hey, Dan, I'd love to catch up and share something I'm doing. I just wanted to see if you know anybody who may be interested. Dan's a social connector and influencer. Dan's absolutely going to refer you one or two people who are going to show legitimate interest. So, point is, we all have connectors in our network. I think you need to do a good job of sitting down and thinking about who those people are, and then just having the courage to really talk about what you're doing and who you're looking for and how it can benefit those people if they were to get involved with you as like a joint venture partner or a passive investor. You will absolutely get referrals. People will say, oh, no, I won't. I can't. That's just a story you're making up in your own head. Until you've tried, don't tell me you can't, right? That's what I tell everybody that I mentor. And the ones that do, they end up raising money and they're like, that was way easier than I thought. The other thing is just get in the habit of talking about what you do all the time. I literally used to raise money from coworkers because I'd come into work on a Monday. What's the first thing everybody does? They make small chat. They're trying to avoid getting into work. And everybody's like, what'd you do this weekend? I always want to be the first person to ask because they always say, oh, after they're done telling their story, they say, what about you? Even if I was at a Red Sox game, right? I'm a Northeast guy. I'm from Connecticut. I go to Boston all the time. Even if I was at a Red Sox game, I lie. This is the only time I'm not a big liar, like, but I would say, oh, I was looking at real estate. I'm really getting into this real estate thing. I'm going to buy multifamily. I've got a bunch of mentors. I'm really excited about it. And they'll be like, wait, what? I didn't know you were into that. Now, here's the kicker. You'll find that if you just talk about what you're doing, not like you're bragging about, you're not asking anybody for money, and you're talking about all that you're learning, and you're talking about how you're bringing on mentors to make sure that you don't make any risky decisions. They're thinking that's super interesting. You know what most people are going to say to you? I've always had an interest. I just never knew how to get started. The reality is, I always joke, everybody and their dead grandmother wishes they can get into real estate because they know it creates more millionaires than any other business model in the world. So once you start talking about it and you start educating people, there's a real opportunity for them to get involved with you. You can do all the heavy lifting. It will blow you away how many people are interested. And let's say I've got 20,000, I've got 30,000, and you'll just start piecing deals together. And eventually you'll meet people as your track record builds who will step up and give you 100,000 or 200,000. And it goes from there. Now, let me just build on the story one more time because that's 14 years ago. Facebook was maybe a thing, but it wasn't the tool for influencers that it is today. If I were starting over, I would be spending, and I'm a big Facebook guy today. I raise millions of dollars from LinkedIn and Facebook now today. So that's a part of my current raising strategy. But get on Facebook, announce what you're doing. I just looked at another property, super excited. Here's where I'm at on my journey. Just said no. You can go to a deal and go home and just talk about why it didn't work. And now you're doing a couple of things. You're making people aware that you're on this real estate journey. And you're showcasing your expertise to them because you're showing all the reasons, all the ways you broke a deal down and why you said no. And what do you think happens the day you call them up and say, hey, I've got a deal here. I think it's a good one. Do you want to go in? They just have been exposed to your expertise and watched you say no to 100 deals. Now you're saying one is great versus they don't ever even know you're on this journey. They know nothing about you being a part of real estate. They don't even think you're an expert. You call them out of the deal and you're like, hey, this is what I'm doing. Do you want to invest? They're going to be like, what? You're in real estate? I'm not going to give you 50,000. Like they have to go through that journey, but it's a great way for you to pull them through this journey with you to know and trust you without ever really actually even talking to them. Social media is just the greatest tool. Again, people will shy away from. Then if people know what I'm doing, then they might also see me fail and they start making up all these crazy stories in their head that aren't true. And nobody really cares that much about you. So I think you have to get over yourselves. Now I'm starting to sound like Gary Vee. But the reality is, be courageous, believe in yourself, share your story. You'll be amazed at how many people will reach out to you and message you and say, hey, I might be interested in partnering with you. So just a couple of tidbits there. I think anybody can do it.
Yeah, no, I think all that is gold, and I concur completely with all that stuff. The biggest hurdle, I think, for most people is the mental block. Once they can get over that and, again, talk about, like you said, what they're doing, what they're into, then it becomes part of their story. Then people start to know them as that person as opposed to Gary from work or whatever. Now it's Gary, that guy from work, is also in real estate. And then pretty soon you become Gary, the real estate guy. Now I'm starting to digress. But the real estate market. I do want to hit on that real quick before we move on because things have been strange, I'll just say, in commercial real estate because for a while I felt like we were in the boom times. Anybody could go out there, invest in a multifamily syndication and double their money in less than 3 years. It was amazing, right? Because
Yeah.
rent prices were going nowhere but sky high in a lot of markets. I won't say that's true in all markets, but I think we all have to recognize that was because of another black swan event, in this case, COVID, that just created these circumstances that likely aren't going to be seen again. And so it was like, what comes after? And what came after were obviously much higher rates for lending, which throws off calculations for purchasing new properties. Values of some properties started to level out, maybe go down. And these properties that guys thought they were going to sell for one number, they're now getting 5, 10, 15 offers for numbers that are much lower than what they wanted and expected. And so we ran into this point in the market where we were stuck. The buyers weren't willing to pay what the sellers wanted, and the sellers weren't willing to sell for what the buyers were willing to pay based on real concerns, right? A rise in cost for materials, for people, the rates for lending, insurance. All of these things were real considerations that were driving the cost of properties up. And so they needed to therefore offer less in order to make money for themselves and their investors. Yep. All that to be said, I'm curious, where do you think we are now? Because I feel like people have given up just waiting for rates to drop, as an example. And they're coming to the reality that, like, hey, deals need to get done. So do you think within the next year or two, we're going to start to see a jump in deal flow within commercial real estate?
I think in the next 2 quarters, you're going to see a jump in real estate. I think there's a lot of sellers who need to sell. Like you said, the expenses have jumped. Taxes, insurance, operating margins have shrunk, right? Profits have shrunk. And they're at a point in time where they're ready to exit. They need to exit. And so it's really only going to take a rate cut or two, which I think we'll see at least one before the end of this year. And I think you're going to start to see a lot of properties hit the market. I think a lot of sellers understand they're just not going to achieve their pro formas. Like you said, buyers and sellers aren't meeting right now, but I think the disparity is just too far. And I get it. So a seller shouldn't sell at a loss. But I think you're going to see the inventory hit the market, and that's only going to continue to grow as rates go down further, provided that they do. There's recessions and economic volatility are a funny phenomenon. It's a social phenomenon more than anything else. Consumer spending is 2/3 of the United States GDP. And as long as consumers are still not only confident but selfish, they're willing to incur debt to have the material goods that they want. That's only going to contribute to an elevated inflationary period. And just recently, it's July 30th, 2024, just for folks to benchmark whenever they're listening to this. They just released consumer spending reports, and it's still pretty elevated considering inflation's coming down. That can raise an eyebrow like, hey, are we potentially going to cut rates and then we're going to see something like we saw at the end of the late 70s, early 80s, where all of a sudden inflation surges back? And the reason why I say that's possible is because if you look at the percent of consumer wages that are being saved versus what's spent, and you look at modern times versus COVID, consumers aren't necessarily making more. The money that was pumped into the market during the stimulus from COVID, that's essentially been burned off. What you find is consumers are actually saving a lot less. They're spending more of their income, and they're leveraging credit a lot more. And so that's a scary situation to be in. So when the consumers are confident and they're willing to spend, that could absolutely contribute to another spike in inflation, which would then not, maybe the Fed doesn't necessarily reverse and hike it again, but certainly that would be a reason to pause for the cause and hold rates longer through next year, which from an economist perspective, which is a lot of what I've done as a consultant over the years, That's really feasible right now. So it's just, I think we're going to see some properties hit the market, but I think there's still enough out of balance that folks shouldn't jump to conclusions that we're in the clear just yet.
Yeah, and I think you're right. Much to the Fed's chagrin, this American consumer has been very stubborn, and this revenge spending slash YOLO spending has gone on much longer than anyone expected. And again, we have this weird dichotomy where people say that the the financial situation is really bad, and you're like, okay, but your spending doesn't reflect that. They're
Right.
still spending as if the financial situation is really good. So it's bizarre. And that's why it's taking so long for the inflation to cool down. I think we might be there. But like you said, the Fed's worst nightmare is he takes his foot off the gas brake, whichever you want to consider it. And then we go back into inflation or, God forbid, hyperinflation again. And I think your other point is important too, that the one thing I didn't bring up when talking about these buyers and sellers are the ones that are in bad situations, distressed sellers who will have to sell. They don't have a choice in the matter. They will have to sell. And so that'll create some deal flow in and of itself. All right. I thought that was an awesome rabbit hole to go down. I love that stuff. But we do need to transition to the turbo round. So I'm going to ask you 3 questions that I ask every guest that's on the show. I just ask for a quick, honest answer. Kris, you ready?
I hope so. Let's go.
All right, let's do it. What is one red flag every investor should look out for?
If an operator is not willing to pull back the curtain and talk about a project where some things were going wrong and the decisions that were made and how that ultimately landed, and then show you the financial statements that go with it, that's a big red flag. We could sit down all day long and show you, here's our pro forma and here's where we landed. We could show you quarter by quarter so you can see where maybe our payroll expenses were elevated or insurance, taxes, or whatever. And I can very specifically talk about the decisions that we made to get things back in line. And so you can see that whole narrative play out through the numbers. And so if somebody's not really willing to talk about things that have gone wrong, that's a red flag. And if they can't show you the numbers, that's a red flag too. Because no project goes wrong.
No, totally agree on the transparency piece there. All right. What is myth about this business that you would like to set straight?
I'll tell you one that resonates with me. There's a lot of influencers online that will tell passive investors, vet the sponsors. Yes, that makes sense. Ask them how many deals have gone full cycle. That makes no sense at all. Anybody could have bought a deal between 2012 and 2022, and the market alone made rookies look like heroes. So don't focus so much on deals that went full cycle, because they could have made a lot of mistakes that got swept under the rug and they just got lucky. So what you really want to look for is, again, going back to what I talked about before, let them show you where mistakes happen and how they corrected things. You get a view into the maturity of their operations when they share the financials. But really what you're looking for is the expertise of the team, not only within real estate, but in business, economics, right? All of those things matter, because rookies will tell you population growth and job growth is what drives real estate markets. And that's just not true. If that was true, every deal in Dallas would be rocking right now. Deals are going belly up in Dallas right now, right? Because supply is the great equalizer. And rookies don't understand they should be looking at supplies. I'll stop there. I guess the myth is, don't think that deals going full cycle is your measuring stick for how bad.
Got it. All right. And final question. What does success look like to you?
Success. What does success look like to me? From an operating perspective, success to me is bringing a deal full cycle, being as transparent as possible, providing timely and clear reports to our investors so they understand what's going on, where are we to plan, and then ultimately delivering that return to them, whether that's above or below or right on, but getting them there comfortably so that they reinvest again. Because I think ultimately folks just want to know, is my capital being preserved? And just the degree to which we can hold their hand and be as transparent as possible, to me, that's a very successful.
There you go. Yeah, leading that investor through the entire process. And I think that's especially true with those first-time investors. If you treat them right, if you treat them with respect and guide them and educate them, because I think that's the other thing that a lot of times we don't talk about, especially first-time investors. They're seeking education as part of this process, and that's what we owe them for their hard-earned money. All right, Kris, this has been awesome. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
I'm a big social media guy. Connect with me there, LinkedIn or Facebook, just Kris Morin, KrisMorin. You can also find me at 3peakscap.com or email me there. I'm super responsive, happy to share resources. I had a lot of people help me along the way.
All right, we'll have all that information in the show notes. Kris, again, I appreciate you coming on, and I look forward to continuing to see you do big things on your journey to multifamily millions.
Thanks for having me.